The Vatican owns 5,170 buildings, apartments across Rome, offices in London, property in Paris, Geneva, and Lausanne. Some of the most expensive real estate on the European continent, held for generations, most of it unmortgaged. The Vatican also cannot balance its budget. It has run a deficit in most of the last 10 years. It owes its own staff a pension it does not currently have the money to pay. And in June of 2026, it publicly asked ordinary Catholics to help cover a shortfall of tens of millions of dollars. Both of those descriptions are accurate. Both come from documents the Holy See published itself. The space between them is one of the strangest financial stories in the world, and almost nobody tells it correctly. We know that first number for a very specific reason. On the 24th of July, 2021, the Vatican published a list of what it owns. Not a summary, not a valuation, not a statement of principle, a list, thousands of entries long, the first of its kind in the institution's history. And it was not released out of conviction. It was released under pressure, in the middle of a criminal investigation into a single building in London that had, by then, cost the Holy See more than $200 million. Hold on the strangeness of that date for a moment. This is an institution that has kept continuous written records since before the Norman conquest. It maintains an archive in Rome with roughly 53 miles of shelving. It has documented its own theological disputes from the 4th century onward in obsessive detail. And yet the plain, boring accountant's question, "What do you own?" went unanswered in public until 4 years ago. That gap is not an oversight. It is a structural feature of how this thing was built, and it explains almost everything about how the money moves. Because the Holy See is not a company, it is not quite a country, and it is not a charity in the way most of its donors imagine. It is a sovereign entity with roughly 800 residents, no income tax, no natural resources, no exports, no manufacturing base of any consequence, and an annual operating budget of about 1.2 billion euros. Where does that come from? Not mostly from the collection plate, not mostly from tourists, and not, in any sense that would satisfy an auditor, from the thing most people picture, a vault of gold under St. Peter's. There is no vault. There is something considerably more interesting, a property portfolio, an investment office, a bank that is legally not a bank, and a stream of obligations flowing from every Catholic diocese on earth toward a few hundred acres on the west bank of the Tiber. For the next 45 minutes, we are going to follow that money, where it came from, and the origin is far more recent and far stranger than you would guess, because the modern Vatican fortune has a birthday, and the man who signed the check was Benito Mussolini. How it was invested, by whom, and with what consequences, including a body found hanging under a London bridge. Where it sits today, building by building. What actually happens to the coin you put in the basket? Why an institution holding thousands of properties cannot close a 7% budget gap. And why, in March of 2026, the largest financial trial in Vatican history was annulled in full and ordered to start again from zero. To understand why the Vatican's finances look the way they do, you have to start with the fact that, for 60 years, it was effectively bankrupt. Until 1870, the Pope was a territorial monarch. The Papal States covered a broad diagonal band across central Italy. At their height, something like 16,000 square miles, with 3 million subjects, a customs service, a treasury, a currency, and an army. The papacy's income came from the things a state's income comes from: land rents, tariffs, taxes on salt and grain, the ordinary machinery of governing people who have no choice about it. Rome was not a spiritual headquarters that happened to have property. It was a government that happened to be run by a priest. Then, in September 1870, the Kingdom of Italy took Rome. The Papal States ceased to exist, and Pius IX made a decision whose financial consequences would last 3 generations. He refused to recognize the new Italian state, refused its offered compensation, and declared himself a prisoner within the Vatican walls. His successors held the line. For 59 years, no pope set foot outside the palace grounds as a matter of policy. The theology of that decision is a separate subject. The accounting is not complicated. An institution that had funded itself through territorial taxation suddenly had no territory. What it had instead was a global membership and a moral claim, and so it did the only thing available. It passed the hat. The 19th century revival of Peter's Pence, small donations from ordinary Catholics worldwide sent directly to the Pope, was not an act of piety looking for an outlet. It was emergency fundraising for an institution running out of cash. By the early 20th century, the Holy See was selling assets, deferring maintenance, and borrowing against the future.
So when people describe the Vatican's wealth as ancient, they are describing the wrong thing. The art is ancient. The buildings are ancient. The money, the liquid, investable, income-producing capital that funds the modern Holy See, is not. It has a birthday. It arrives all at once from a single source on a specific morning in February 1929. And the man who signed the check was Benito Mussolini.
The Lateran Pacts are usually remembered for what they created: Vatican City, the world's smallest sovereign state, 121 acres, recognized in international law. That was the first of the 3 documents signed that day. The third one is the one that matters here, and it is titled, without ceremony, the Financial Convention. Its terms were these. Italy would pay the Holy See 750 million lira in cash and hand over a further 1 billion lira in Italian state bonds carrying 5% annual interest. Adjusted forward, the package is worth something in the region of $1.6 billion in today's money. To grasp what that meant in 1929 Italy, consider the comparison that historians of the period keep returning to. The settlement amounted to roughly a third of the Italian government's entire annual budget. One payment to one recipient. Mussolini's motive was not devotional. He was 3 years into consolidating a dictatorship in a country where the church commanded loyalties his party could not reach. And the Roman question, the unresolved standoff since 1870, was the most conspicuous wound in Italian public life. Settling it bought him the moral legitimacy of the papacy at a moment when he needed it. Pius XI, for his part, got the thing his 4 predecessors had refused on principle: recognition, sovereignty, and a solvent balance sheet. Both men understood exactly what was being exchanged. And here is where the Vatican's financial history genuinely begins. Because 1.75 billion lira sitting in a treasury is not wealth. It is a depreciating pile of paper, and an economy heading, though nobody in that room knew it yet, into a global depression 8 months away. Cash left alone in 1929 was cash destroyed. The settlement was not the fortune. The settlement was the seed. Which raises the question that every institution receiving a sudden windfall must answer, and which the Church had almost no institutional experience of answering. Who invests it? The Roman Curia in 1929 was staffed by canon lawyers, theologians, and diplomats. It contained, so far as anyone could determine, not one professional asset manager. So Pius XI went outside. And the man he chose was not a cleric at all. Bernardino Nogara was a mining engineer. That is not a detail thrown in for color. It is the whole explanation of what followed. Before he ever handled a lira for the Holy See, Nogara had surveyed mineral deposits in Wales, run projects in Bulgaria, and worked on industrial and banking ventures in the Ottoman Empire. He was a technician of extraction, comfortable in foreign jurisdictions, fluent in the language of concessions and currencies, and, critically, a layman with a brother who happened to be a senior Vatican archaeologist. In 1929, he was appointed to run the newly created Special Administration of the Holy See, the vehicle built to hold the Italian settlement. Accounts of his appointment describe him accepting on conditions. He wanted the freedom to invest anywhere in the world, in any sector, without restriction on grounds of doctrine, and to reinvest returns as he saw fit, rather than releasing them to fund current spending. Whether those terms were as explicit as later tellings suggest is disputed by historians. What is not disputed is that his conduct matched them precisely. Nogara ran the money like a professional fund manager, operating in his own century, not like a steward of a religious institution operating in the 19th. The results were extraordinary and, in the context, almost implausible. Working through the Great Depression and into the instability preceding the Second World War, the worst investing environment of the modern era, Nogara is credited with multiplying the initial capital roughly 20-fold within a decade. He diversified out of lire into gold, sterling, and dollars before Italy's currency weakened. He bought into Italian industry at depression prices: banking, insurance, utilities, construction, telephony. By the middle of the century, estimates put the Vatican's holdings at somewhere between 10 and 15% of the total value of the entire Italian stock market.
Sit with that figure, because it changes the picture. This was not a church with a savings account. For a stretch of the 20th century, the Holy See was among the most significant single blocks of capital in one of Europe's largest economies. A quiet, permanent, tax-advantaged shareholder in the machinery of Italian industry. And it had achieved that position not through centuries of accumulation, but in about 20 years, using money it had been handed by a fascist government, invested by an engineer. Nogara served until 1954 and died in 1958. The structure he left behind is the structure that still exists in modified form, a professional investment arm managing a diversified portfolio, funding an institution whose public identity has nothing to do with investing. Everything that comes next, every scandal, every reform, every restructuring, is an argument about how to govern that inheritance. And the first serious argument was about to arrive, wearing the uniform of a bank. In 1942, with Europe at war and Rome under a fascist government, Pius XII established an institution with a name that gives away nothing: the Istituto per le Opere di Religione, the Institute for the Works of Religion. Everyone calls it the Vatican Bank. Legally, that description is wrong in a way that turns out to matter enormously. The IOR does not lend commercially. It does not underwrite, it does not issue mortgages, or run a trading desk in the ordinary sense. What it does is hold and move money on behalf of a defined client list: religious orders, dioceses, Vatican employees, clergy, and institutions of the Catholic Church. And it does so from inside a sovereign state that is not a member of the European Union, not subject to Italian banking supervision, and for most of its history, not subject to anyone's banking supervision at all. Consider what that combination produces. A religious order in a country with capital controls needs to move funds to Rome. A diocese in a jurisdiction with an unstable currency wants to hold dollars. Perfectly legitimate needs, and the IOR exists to meet them. But the same architecture, an account inside a sovereign wall, held by an entity with no obligation to report to any external authority, is also, viewed from the outside, an extremely attractive object. Not because anyone designed it as a laundry, because sovereignty plus opacity is a product, whether or not you intended to sell it. For decades, the Institute operated with a governance structure that would not survive 10 minutes of modern scrutiny. A supervisory commission of cardinals, most of them with no financial training, overseeing a lay director, with an internal audit function that was, in practice, whoever the director trusted. There was no regulator. There was no published balance sheet. Until 2013, the IOR had never released an annual report in its 71-year existence. This is the point where the Vatican's finances stop being a story about clever investing and start being a story about control. Nogara built a portfolio. What nobody built for the better part of half a century was a system for checking on the people managing it. Institutions tolerate that arrangement right up until the moment it produces a corpse under a bridge in London. On the morning of the 18th of June, 1982, a maintenance worker found the body of a 62-year-old Italian man hanging from scaffolding beneath Blackfriars Bridge in the city of London. His pockets and clothing contained roughly 5 kilograms of bricks and around $15,000 in 3 currencies. His name was Roberto Calvi. He was the chairman of Banco Ambrosiano, and the Italian press had spent years calling him God's banker. Banco Ambrosiano collapsed that same month, carrying debts of approximately $1.3 billion. At the time, the largest and most damaging banking failure in post-war Europe. The mechanism of the collapse was a network of offshore shell companies, principally in Panama and the Bahamas, through which money had been cycled in ways that made the bank's true exposure impossible to read from its accounts. And the Vatican Bank sat inside that network. The IOR held a stake in Ambrosiano. Several of the offshore entities at the center of the structure were, on paper, controlled by it. The most consequential detail was a set of documents known as letters of patronage, issued by the IOR under its president, the American Archbishop Paul Marcinkus. These letters acknowledged the Vatican Bank's relationship with the offshore companies, in language that stopped just short of guaranteeing their debts. International lenders read them as comfort. They lent accordingly. When the structure failed,
Those lenders discovered that comfort is not collateral, and that the counterparty they had implicitly relied upon was a sovereign entity they could not sue in any ordinary court. Which is exactly what happened. Ambrosiano's creditors could not compel the Holy See to appear before an Italian judge, because the Holy See is not an Italian person. What followed was 2 years of negotiation conducted between lawyers and diplomats, concluding in 1984 with a 161-page agreement under which the Vatican paid $244 million to roughly 120 creditor banks. The payment was made, in the language of the settlement, in recognition of the Vatican's moral involvement. Not legal liability, moral involvement. No admission of wrongdoing, no finding of fault, no court. That phrase is worth holding on to because it captures the central financial fact about the institution we are examining. Sovereignty is not merely a status, it is an asset with a cash value. The value of never quite being reachable. For 50 years after Nogara, that asset was worth more than any building in the portfolio. And the entire reform effort of the last 15 years, which we will come to, is best understood as an argument inside the church about whether that particular asset should be spent down on purpose. Strip away the history and the scandal and ask the flat question. Today, in the mid-2020s, where does the money actually come from? The answer is 4 streams, and they are wildly unequal in size, reliability, and public visibility. The first and largest is patrimony, the income thrown off by the assets Nogara's successors inherited and expanded. This is managed by an office called APSA, the Administration of the Patrimony of the Apostolic See, and it is effectively the Vatican's investment company and landlord rolled into one. In its 2024 financial statement, APSA reported net profits of 62.2 million euros, up 16 million on the prior year, and transferred 46.1 million of that to the Holy See, 30 million as a fixed contribution, and the remainder as half of what was left. That transfer is the closest thing the Vatican has to a dependable annual income. The second stream is donations, and it is the one the public understands least accurately. It includes Peter's Pence, the worldwide collection taken up around the feast of Saints Peter and Paul, plus direct gifts, bequests, and foundations, plus obligatory contributions from dioceses around the world. We will spend serious time on this because the gap between what donors believe they are funding and what the ledger records is the single most contested question in Vatican finance. The third is commercial activity inside Vatican City itself. The museums, the post office, the pharmacy, the supermarket, publishing, the sale of stamps and coins. Note carefully that this is a separate budget. The Government of Vatican City State, which runs the physical territory, keeps its own accounts, distinct from the Holy See, which is the governing body of the global church. 2 entities, 2 budgets, 1 set of walls. Almost every confused headline about Vatican finances comes from someone conflating the two. And the fourth is the IOR, which does not strictly fund anything. It holds deposits and manages assets for church clients, and it distributes part of its profit to the Pope for his purposes. In 2024, it reported net profit of 32 million euros, 7% above the prior year. Real money, but a rounding error against a 1.2 billion euro operating budget, which tells you where the weight sits. If you want to understand the Vatican's economy, you do not look at the bank. You look at the buildings. Return to that list from July 2021, 5,170 properties, and ask why it appeared when it did. The answer is that it did not appear because someone in the Curia woke up committed to transparency. It appeared in the same window as a criminal investigation into a London property deal, and it was released as part of a deliberate strategy. Get ahead of the story by publishing the whole portfolio. What the disclosure showed is a landlord of unusual scale and unusual behavior. APSA's 2024 statement records 4,234 real estate units under its management in Italy alone, of which 2,866 are owned by APSA directly, 1,367 residential, 395 commercial, the balance in other categories. Beyond Italy sit the foreign holdings, administered through outside companies, concentrated in exactly the cities you would expect a long-horizon institutional investor to concentrate in: London, Paris, Geneva, Lausanne. Prime European real estate, held for generations, largely unmortgaged. Now the number that changes how you read all of it. When the 2021 disclosure was analyzed, roughly 40% of the Italian buildings turned out to be institutional in use: schools, hospitals, convents, seminaries, offices of the church itself. And of the remainder, only about 14% were leased at market rate. 14%. The rest were let at below market rents, and a substantial share of those below market tenancies went to church employees, clergy, and religious institutions. This is the paradox at the center of the Vatican's balance sheet, and it is not fraud. It is a portfolio being used for two incompatible purposes at once. Judged as an investment, it is dramatically underperforming. Billions in prime European property yielding a fraction of what a commercial owner would extract. Judged as social policy, it is doing precisely what it was intended to do: housing the people who staff the institution at rents they can afford, in a city where market rents would price them out entirely. Every euro of foregone rent is, in effect, an untaxed subsidy paid in kind. But subsidies have to be funded, and this one is funded by the gap between what the portfolio earns and what the institution spends, which is how an organization holding thousands of buildings in some of the most expensive cities on Earth arrives year after year at a deficit. It has enormous assets and modest income because it has chosen, deliberately, and largely without saying so out loud, not to monetize what it owns. And so the shortfall has to come from somewhere else. It comes from the collection basket. Once a year, in Catholic parishes across the world, a second collection is taken up near the feast of Saints Peter and Paul. It is called Peter's Pence. It dates in its modern form to the 19th century emergency we described earlier, and it is presented in parish bulletins, in promotional materials, on the Vatican's own website, as the Holy Father's charity. Support for the poor, relief after disasters, the Pope's works of mercy. In December 2019, the Wall Street Journal published an investigation into where that money went. Its finding, covering roughly the period 2014 to 2019, was that only about 10% of Peter's Pence had been spent on charitable works. Roughly 2/3 had gone to covering the Holy See's budget deficit, the ordinary running costs of the Roman Curia: salaries, buildings, diplomacy, administration. The Vatican's response was not to deny the numbers. It was, in substance, to explain them, and the explanation is legally airtight. Under canon law, Peter's Pence is given to the Pope for the exercise of his ministry, and the Pope may apply it to anything that serves that ministry, which includes the apparatus that carries it out. Running a global institution that operates schools, tribunals, nunciatures, and relief agencies is not a diversion from the mission. Administration is the mission, or at least its skeleton. That argument is coherent. It is also not what the parish bulletin says. And the pattern has held. In 2023, of 103 million euros dispersed from the fund, 90 million, about 87%, went to the operations of the Roman Curia, while 13 million went to direct assistance for those in need, spread across 236 projects in 76 countries. The 2025 figures, published in mid-2026, show the same shape at a smaller scale. 54.5 million euros in total, of which 13.3 million was allocated to charitable projects and papal priorities, and 41.2 million to curial departments and operations. So the honest description of Peter's Pence is not that it is a fraud. It is that it is a general fund marketed as a restricted one. Donors give, believing the euro follows the shortest possible path to a person in need. In practice, the euro underwrites the institution, and the institution then does, among many other things, charitable work. Whether that distinction bothers you is a question about you. What it tells us structurally is unambiguous. A body with billions in assets is using small denomination charitable giving to close an operating gap. And Peter's Pence is only the visible part of what the global church sends to Rome. Here is a fact that surprises even practicing Catholics. The Vatican does not fund itself primarily from Vatican City. It is funded, substantially, by the rest of the church, by more than 3,000 dioceses spread across every inhabited continent, most of which send money to Rome every year. The mechanism is written into canon law. Under the 1983 Code, diocesan bishops may be required to contribute to the needs of the universal church. And in practice, this operates as a set of expected annual payments, calibrated to the wealth of the local church. A diocese in Germany, funded by the Kirchensteuer, the state-collected church tax that generates billions of euros annually from registered Catholics' payrolls, is in a different category from a diocese in sub-Saharan Africa, and the flows reflect that. Money moves, overwhelmingly, from the wealthy northern churches to Rome, and from Rome outward to the poorer ones, which produces a dependency that is rarely stated plainly. The single most important variable in the Holy See's medium-term finances is not the return on its portfolio. It is the health of the church in the countries that pay: Germany, the United States, Italy, Ireland, Australia, the wealthy dioceses of the developed world. Those are precisely the countries where mass attendance has fallen hardest, where formal disaffiliation is highest, and where abuse settlements have consumed diocesan reserves at extraordinary scale. In Germany alone, hundreds of thousands of registered Catholics have formally left the church tax rolls in recent years, and each departure is a permanent line removed from a revenue base. Layer onto that a second stream with its own logic. The Dicastery for Evangelization, for centuries known as Propaganda Fide, holds a large and largely separate patrimony of its own, built up over generations from bequests intended to fund missionary work, and it functions as a substantial Roman landlord in its own right. The scale is visible in an unexpected place. In 2014, the congregation paid over 2.16 million euros in Italian municipal property tax on its Rome holdings alone. That is a tax bill, not a valuation, but a tax bill of that size implies a portfolio of a certain order of magnitude. So the picture is now complete enough to state properly. Rome is funded by a global membership through obligatory contributions, by voluntary giving that partly closes its deficit, by a property portfolio it declines to fully monetize, and by an investment arm generating a few tens of millions a year. 4 taps, 3 of them constrained by demography or policy. That leaves one part of the operation that behaves like an ordinary business, and it happens to be the most successful thing the Vatican does. Every year, roughly 7 million people pay to walk through the Vatican museums. In 2024, ticket and merchandise revenue approached $100 million, recovered fully from the pandemic collapse and running at pre-2020 levels. The museums are, by a wide margin, the most commercially effective operation the institution runs. The economics are close to ideal. The inventory, Michelangelo's ceiling, Raphael's rooms, the Laocoon, the map gallery, the Egyptian and Etruscan collections, is unique, cannot be reproduced, and costs nothing to acquire in any accounting sense, having been assembled over 5 centuries through patronage, purchase, and papal commission. The building is owned outright. Demand is inelastic and globally distributed, insulated from any single country's economy. There is no competitor, because there is exactly one Sistine Chapel. Conservation costs are real and rising, but they are a fraction of gross receipts. The 2025 Jubilee, the Holy Year, declared at intervals of roughly 25 years, which draws pilgrims to Rome in extraordinary numbers, put that machine under maximum load. Vatican sites recorded sharp increases across every measure of visitor engagement, with reviews of Vatican points of interest up around a third year on year, and the museum's own visitor satisfaction index climbing to nearly 90 out of 100. The Jubilee did what it was designed to do commercially. It redirected an enormous share of Rome's tourist flow and its spending inside the walls. But, and this is the structural point, museum revenue does not solve the Holy See's problem, because it largely does not reach the Holy See. The museums sit under the governorate of Vatican City State, which runs the territory, the gardens, the security force, the utilities, the physical plant. The governorate is generally the healthier of the 2 budgets. The Holy See, the Curia, the diplomatic corps, the dicasteries, the global governing apparatus, is the one that runs the chronic deficit. Money can be moved between them, and is, but they are not the same balance sheet, and the profitable half is not the half with the problem. Which brings us to the deficit itself, and to the number that has defined Vatican finance for a decade. Against total operating spending of roughly 1.2 billion euros, the Holy See has run a structural shortfall, estimated in the range of 50 to 90 million euros a year, around 7% of budget. Not catastrophic in a single year, fatal over 20 if nothing changes, because deficits are funded by drawing on capital, and capital drawn down does not come back. And it was precisely an attempt to escape that arithmetic, to make the money work harder, that produced the worst financial disaster in the modern history of the church. The building is on Sloane Avenue in Chelsea, central London. It was built in the 1920s as a Harrods furniture depository, a bulky, handsome, red brick warehouse. And by the 2010s, it was the kind of asset that London developers dream about. A large site in a prime postcode, ripe for conversion into luxury flats. In 2014, the Secretariat of State of the Holy See began putting money into it. Understand first why that is strange. The Secretariat of State is the Vatican's central governing and diplomatic office, the papal chancellery, in effect. It is not an investment vehicle, but it controlled its own funds, including a share of Peter's Pence, and it invested them independently, outside APSA, with its own advisors and its own internal approvals. The initial route in was through an offshore investment fund, into which the Secretariat placed a very large sum for a minority position in the building, with the fund's manager retaining control. What followed was a case study in how sophisticated intermediaries extract value from an unsophisticated institutional client. The structure was complex and expensive. Fees accumulated. The Secretariat found itself holding an interest it could not control in an asset whose development was not proceeding as promised. To gain control, it bought out the position, and in doing so, entered a further arrangement with a second London-based broker in which, according to the Vatican's own subsequent prosecution, it paid a substantial sum to acquire the shares that carried voting rights over the building. By the time the Holy See finally sold the property in 2022, the accumulated loss ran to more than $200 million. That figure deserves to be set against the others in this script. It is more than 3 times APSA's entire annual profit. It is roughly double what Peter's Pence disperses in a strong year. It exceeded on its own several years of the structural deficit that the same money might otherwise have covered. One building, one deal, one office operating without effective oversight. And the reason we know any of it, the reason the property list was published in 2021, the reason APSA now issues public accounts, the reason the Secretariat of State no longer manages its own investments, is that this deal did something no previous Vatican financial scandal had done. It did not end in a negotiated settlement between lawyers. It ended in a courtroom, inside Vatican City, with a cardinal in the dock. It was called, inevitably, the Trial of the Century. It opened in a converted hall inside the Vatican Museums complex in July 2021, ran for 2.5 years across scores of hearings, and put 10 defendants in front of a Vatican tribunal on charges including embezzlement, fraud, extortion, and abuse of office. The senior defendant was Cardinal Angelo Becciu, formerly the substitute for general affairs, the number 3 official in the Holy See, and for years, one of the most powerful administrators in Rome. On the 16th of December, 2023, the court convicted him. 5 years and 6 months in prison, a fine of €8,000, and permanent disqualification from public office. The judgment stated that the conviction rested on full and irrefutable evidence that Becciu had committed Vatican funds to a highly speculative London property transaction, in total disregard of the institution's own rules. Other defendants received sentences of varying length. Some charges failed. The significance was not the sentence. It was the fact of the proceeding at all. For the first time, a cardinal had been tried by lay judges in a Vatican criminal court in a case brought by Vatican prosecutors over the management of Vatican money, the exact opposite of the 1984 Ambrosiano outcome, where sovereignty had been used to keep the matter out of any court. To make it possible, Pope Francis had to amend Vatican law twice, removing the privilege under which a cardinal could be tried only by his peers. Sovereignty was, on purpose, being spent down. Then, in March 2026, it collapsed. The Court of Appeal of Vatican City State declared the entire first instance procedure null on grounds of serious procedural error. Issues that had been raised from the beginning by defense lawyers concerning the powers used by prosecutors during the investigation and the rights of the accused. The convictions of December 2023 were annulled. The case was ordered to begin again, from its initial phase. 2.5 years of hearings and the verdict that followed them ceased to have legal effect. Read that development carefully, because it can be read 2 ways, and both are defensible. One reading: the reform failed its first real test. The Vatican built a court capable of trying a cardinal, but not a procedure capable of surviving appeal, and the outcome is delay that runs in favor of a 77-year-old defendant. The other, an appellate court applied due process against its own institution's prosecution, in public, and that is precisely what an independent judiciary is supposed to do. What is not in dispute is the money. More than $200 million left the Holy See and did not come back, and no ruling of any court restores it. Which matters, because there is a much larger number waiting. Everything discussed so far, the deficit, the London loss, the underperforming portfolio, belongs to a category of problem that money can fix. There is one that cannot be, and it is the largest single figure on the Vatican's books. The Holy See employs several thousand people: Curia staff, Swiss guards, museum workers, gardeners, technicians, security, administrators, many of them lay, most of them on career-length contracts, all of them entitled to a pension. The Vatican Pension Fund is the obligation to pay them. In 2022, the Secretariat for the Economy estimated the fund's shortfall, the gap between what it holds and what it owes, at 631 million euros. In the months before his death in 2025, Pope Francis warned publicly that the fund could not, in the medium term, meet its obligations, and estimates by then had climbed toward 1 billion euros. Compare that to the income statement. A PSA's best recent year produced 62 million euros of profit and transferred 46 million to the Holy See. The IOR contributed 32 million. Peter's Pence disbursed 54.5 million in 2025. Add every reliable source together, and the annual surplus available to attack a billion-euro hole is, in a good year, a few tens of millions, before covering the operating deficit that already consumes it. On those numbers, the shortfall is not closable from income. It is closable only by selling assets, cutting benefits, or dramatically increasing revenue. And each of those has a cost the institution has been reluctant to pay. Selling assets means selling buildings, which means evicting below-market tenants who are, in many cases, the same employees the pension is owed to. Cutting benefits means reducing the pensions of people who spent their careers in church service at below commercial salaries in exchange for exactly that security. Increasing revenue means either raising rents to market, the same eviction problem, or asking a shrinking donor base in wealthy countries for more, at the moment it is least able to give. This is the real financial position of the Vatican, and it is worth stating without drama. It is asset-rich and cash-poor. Its largest holdings are deliberately unproductive for reasons that are humane rather than incompetent. Its most reliable income depends on the religious practice of populations that are disaffiliating. Its largest liability grows automatically with time and cannot be outrun by any plausible investment return. This is not the profile of a secret empire. It is the profile of a legacy institution with a defined benefit problem. The same problem confronting old airlines, old steelmakers, and more than a few American cities. Which brings us to the present, and to a pope who inherited all of it. Robert Prevost was elected in May 2025 and took the name Leo XIV. On finance, his inheritance was mixed in an instructive way. The reform architecture built under Francis was largely in place. Investments centralized at APSA under a 2022 decree that closed departmental accounts and moved roughly 2 billion euros of holdings under unified control. An ethical investment policy excluding weapons and certain other sectors. Public accounts from APSA and the IOR. An external anti-money laundering evaluation by Moneyval, the Council of Europe's assessment body, which first examined the Holy See in 2021 and issued a follow-up in May 2024, recognizing substantial progress, while identifying internal corruption, not external laundering, as the jurisdiction's primary residual risk. That is a striking finding. The danger was never mainly the outsider using the Vatican. It was the insider. The results so far are genuinely two-sided, and it would be dishonest to present only one. Reported figures improved. 2024 closed better than prior years, with a small headline surplus and a structural deficit roughly half the previous years. The IOR recorded a sharp rise in income during Leo's first year, reported as the strongest growth in over a decade, driven substantially by his personal popularity, particularly among American Catholics. On the other side, in June 2026, the Vatican launched a public campaign asking ordinary Catholics to help erase a deficit put up between $57 and $68 million. Peter's Pence receipts, meanwhile, fell rather than rose. Asked about the state of the finances, Leo's own public answer was that he was not losing sleep over it. If you have followed this far, you can now evaluate that answer yourself, which is the point of an exercise like this. The Vatican is not concealing a treasury. It is managing a $200 million hole in Chelsea, a €1 billion pension liability, a property portfolio it will not fully monetize, and a donor base concentrated in countries where the faith is contracting fastest, with tools that are more transparent than at any point in its history, and still, by the standard of any comparable institution, unusually weak. Every serious number in this script comes from documents the Vatican itself published, or from a court it itself convened. That is the actual change of the last decade, and it is not nothing. If this is the kind of story you want more of, following the money through institutions that were never designed to be audited, subscribing helps more than you would think. And if you know someone who assumes the Vatican is simply rich, send them this. And if there is an institution whose balance sheet you think deserves this treatment, put it in the comments. We read them, and several of these videos started there. Because here is where the arithmetic finally lands. For 59 years, the papacy was a prisoner with no income. For the next 50, it was a shareholder in Italian industry, funded by a dictator's settlement and run by an engineer. For 30 years after that, it was a sovereign wall that could not be sued. And now, it is something it has not been since 1870, an institution that has to publish what it owns, explain what it lost, and ask a shrinking number of people to cover the difference. The Vatican did not become poor. It became accountable. It is still working out what that costs.